So the inflation data came out today, because we're recording this on the Friday. The US inflation data came out. It's fallen to 2.4%. And obviously crypto then had a little bit of a dip, but is now at about $67,000-ish.
Yep.
I'm just reading here on the latest thing from crypto.news that apparently all the market capitalization for all tokens has dropped 2.29 trillion, but it then doesn't give me a time frame, which is helpful. But crypto's had a bit of a rocky last 12 months or so. What's happened? Tell me. I don't know anything about the market. What has happened in crypto?
Yeah, where to start? Look, my approach, I guess, to crypto is I'm given my background, very much like macro trader, and think about crypto from that side of things. So I think about crypto in the same way I think about FX rates, commodities, and I think it within that framework. And within that framework, like, liquidity drives everything. Right, that's like the number one thing. I think the same for equities, right? It's rates and liquidity are like the two most important things. And for me, like, the world around that changed like post 2008, right? So without going too much into that, but we had a financial crisis that was, driven by this massive credit cycle that kind of collapsed. But we were so extended within that the response was, well, we were staring at the abyss and the end of the financial system. So they inflated all the assets in the system that were the collateral that underpinned the entire financial system. So we've lived forever with these artificially inflated assets, and the consequence of that, to keep them inflated, you constantly need like more liquidity coming in. And then to maintain growth, we constantly need sort of more debt, right? And that debt needs financing, which needs more liquidity. And then consequently, like, this is the debasement trade that people talk about. When you're printing money, you're debasing like the value of that money. So everything for me comes around like these liquidity cycles, and that like kind of beats anything else more fundamental. So when I look at crypto, like what's gone on over the past year, like, let's not forget, and I do separate Bitcoin from crypto itself. I think like they're two kind of almost very different asset classes. I think of Bitcoin like digital gold, digital property, whereas I think of other cryptos like tech plays. And so that's kind of how the distinction. But I think broadly, if I'm thinking about Bitcoin, obviously we hit record highs in October. Now, I think part of what drove, so global liquidity, and you think of money supply, and there's other factors that feed global measures of liquidity, like credit spreads, equities, like bond market volatility, all these things that you'd kind of think about to provide a measure of liquidity. Global liquidity has sort of been high because you've had China pumping a lot of stimulus in. We've had a global rate cutting cycle over the last few years. So that's kind of driven all assets higher, and Bitcoin and crypto performs sort of really well over the last few years, ex the past year. What's been offsetting the global liquidity is, until December of last year, was you had the Fed doing quantitative tightening, reducing the balance sheet. And obviously they went into a rate cutting cycle, but it's been very slow. But they've been draining liquidity through the balance sheet. But there's been a massive offset to that, and that was the Fed's reverse repo facility, right? So essentially, during COVID, there was loads of cash printed, as we know, there was loads of excess cash in the system, and eventually it had no home to go to. So it was just parked at the Fed in this overnight facility where they pay interest on it. Now, as they started draining the balance sheet, as more treasury bills are getting issued to pay for all this massive debt that we've got, rates in the market were higher. So that money started coming out of just being sat idle at the Fed, coming back into the market. And this was over like $2.5 trillion. So even though the Fed were kind of reducing the balance sheet, you had this massive offset of $2.5 trillion of cash since 2023 that was coming into the market. That went to zero, right, at the end of September, right? Bitcoin topped on, I think, around the 6th of October. And at the same time, so you had this massive wave of liquidity that was supporting markets finish. The Fed was still doing QT, quantitative tightening, reducing the balance sheet. You also had at the same time that the US government went into shutdown. Now, what that means, they're still able to issue debt, so they're taking cash out of the market, but they can't spend that cash. So that's another drain on liquidity. So in Q4 of last year, we had this huge sort of drain on liquidity. We started to see funding issues in the US sort of banking system, where you've seen repo rates start to, and again, it wasn't like massive stress, but there were signs of tightness there. That drove the decision in December for the Fed to actually end quantitative tightening, and then go one step further and say, right, we're now going to start, and people argue, is this QE or not QE? But we're going to now start expanding the Fed balance sheet again and buying treasury bills to the tune of $40 billion a month, right? So the way I'm thinking about it is you had the RRP essentially provided liquidity that offset all the tightening that was going on with quantitative tightening. That ended in October. Things started to kind of get a little bit messy and blow up. Fed then ended QT in December, announced these RMP purchases, reserve management purchases of 40 billion a month. So I was expecting into January for us to start actually picking up, right, and start and crypto to actually start going back to its record highs, and Bitcoin start going back to record highs. We actually started the year quite well, and then mid-Jan you had the whole Greenland and Trump stuff, and I'm going to take over Greenland. That just kind of knocked risk generally. Then we had concerns into the end of January around another government shutdown. We kind of narrowly averted that, and then we had the Fed's nomination, or Trump's nomination, for Walsh as the next Fed governor, chair. Now, the fear around him is that this is a guy that in the past has said he wants to shrink the Fed's balance sheet. So we kind of had a little bit of a wobble around that as well. And then in the meantime, you've seen now there's a correlation obviously in crypto and tech and high beta tech. So it still trades, even though I think there's different definitions that we can get into, but it trades very much as a high beta risk asset, which we kind of think of tech. We've also, over the last couple of weeks, started to have this fear around AI actually cannibalizing the value in a lot of tech stocks, particularly software companies, where AI is going to actually sort of take over and reduce a lot of the value of those companies. So you've actually seen like the Mag 7 and the big tech companies start to underperform, because we're trying to question, firstly, how are they going to be impacted by AI itself and disrupted by AI itself? And then you see a massive capex from the Mag 7 on AI that we're now questioning, well, you know, what will the returns look like to that capex? We're pushing those returns out further into the future. They're also taking a lot of cash out of the market. So I think that whole tech sector has been under pressure, and we're seeing that rotation back to value. And that's additionally weighed on crypto. And we've not been able to see the impacts of this Fed picking up, like the US liquidity pulse picking up, which I think will start to reassert itself. But right now we're just kind of getting hit along with the tech stocks. So long story short, I think it started with the liquidity problem in Q4. I think it's kind of carried on with all this uncertainty around tech and like that sector, which Bitcoin and crypto is particularly correlated to, just being questioned and coming under pressure.
So just for those who aren't from a macroeconomic background like yourself,
Yeah.
Explain quantitative easing and quantitative tightening, why a central bank does it and what those impacts are. Because I think a lot of us are aware of quantitative easing post 2008, because that was when it was kind of mainstream news. But quantitative tightening seems to be a kind of term that's been in the news a lot more in the last year or so.
Yeah.
What are they both? How are they different, and why does a central bank do them?
Yeah, so there's, I guess, a couple of reasons. So like firstly, if we look at like 2020 and obviously the world blew up in COVID and the treasury market was under huge pressure. Firstly, like the Fed need to support the treasury market, right? And if people aren't buying treasuries, then the Fed are essentially saying, we will support that market and we will print money to buy those treasuries, like quantitative easing. Um,
And when you're saying treasuries, this is debt against the government.
US government debt, yeah.
Yeah.
So we had a situation where, again, it was like world's blowing up. The US themselves were having to, obviously, as we were in the UK, printing, doing a lot of fiscal to support the economy and to support businesses during shutdown, lockdown, and that someone has to pay for that. Right now, who's going to pay for it? Well, when the whole market's like, everyone's, there's this huge uncertainty, no one knows what's going on, so everyone takes all chips off the table, reduces all risk. But it's like, well, we need someone to buy the treasuries, and we've got all this new debt coming on, we need someone to buy that. And if you're uncertain and you're not, and the investors aren't going to buy it, well, then someone has to, otherwise the whole system collapses. So the Fed prints it, basically. There's other reasons as well, like when we've got to zero interest rates, then it's like, well, we're at the zero rate, and if you're still in like a deflationary world, and you're seeing this in likes of China, like we're still in this deflationary world, but we've hit the zero lower bound, like, well, we can go negative with rates, and we did that in Europe. You've seen Switzerland do the same. But what we can also do is if we do quantitative easing and print money and we buy treasury bills, then we can start lowering yields, like what they call across the curve, right? There's different sort of yield benchmarks. So like, say 10-year yields might start to have a bigger impact on where mortgage rates, say in the US, trade. So we need to lower, we can't influence that so much with front end rates, but if we can lower yields further out, then we kind of lowering like yields and interest rates throughout the broader economy. But the other thing as well to stimulate is there's this idea of this wealth effect. That, so look, if central bank buys up the government bonds, right, and they essentially we call take that duration out of the market. If we buy the bonds, then investors have to search for returns elsewhere, and it pushes them further out of the risk curve, right? Which is why you tend to see equities then start to perform. And then the idea with that is if equities are performing, then you get this wealth effect that then starts to feed through into the broader economy, and everything gets going again. So it's seen as like an additional kind of monetary tool alongside using interest rates, but it also performs in times of stress. We need to provide liquidity for funding markets and for the treasury market to function. So when it's not functioning, you will see the Fed do this quantitative easing, print cash to buy the treasuries to get everything going again. Quantitative tightening is the reverse to that. So when they now go, right, we don't need to do that anymore, things are supported on their own, and now we've got this huge balance sheet where we've got all these treasury bonds, now we want to start to reduce that. So what they do, they don't typically go and sell those, but once they mature, once that, say you're holding a 2-year treasury and then that maturity, then instead of refinancing it or rolling that, they just allow that to roll off, i.e. they get paid back for that, right? So the government essentially has to then give the Fed that money back, but then the government still need that money, so then they have to issue new debt. And then what that means is, but obviously because the Fed have just printed it in the first place, you've now given that money back to them. Now that kind of money is just dead. The government, meanwhile, still need to, we need to replace that because we're not in a position to pay back the debt, really. So then they reissue the debt in the market, and then that cash has to come out of somewhere else. So that's why then you're actually you're kind of reversing the quantitative easing effect, and now you're starting to, right, we need this cash to come out of other areas, which is typically why it's bad for risk, and that when you start to see balance sheets shrink. Does that make sense?
Yeah, I think it's a quite a good and detailed explanation of how government budgets are not like household budgets, like we got told in 2008, because you've got all these tools and all these levers and the independence of a central bank. That means that you can't then say, oh, this is what I've got going in, this is what I've got coming out, because it doesn't work like that.
No, it doesn't. What I will say though is it doesn't work like that, but there's also no free lunch, and you can't just print money without you know, you can't just print money and it have no kind of impact. And if you haven't got the increase in productivity, it will manifest itself as inflation. Now, for years, we didn't see that inflation in the real economy because the inflation actually happened in the asset markets, in what I call like the financial economy. So you didn't see it in the real economy when, you know, post 2008, because it was this whole cycle that I just described. The Fed and others, Bank of England, were doing the same. They were buying the government bonds. Those investors that held the government bonds were then forced to then look at other things, equities. All that money was staying within the financial economy and financial markets and inflating assets. So rich got richer, and it didn't really feed down. And the wealth effect and trickle down into the real economy is very, very weak, right? So it didn't really feed itself down. So you saw the rich getting richer, but the inflation showed up in asset prices. What was different in 2020 was they actually, there was a lot of the money, because they were issuing so much debt and actually putting cash in people's pockets, right, through like all the stimmy checks and all this stuff, that actually was feeding into the real economy. But not only did you not have an increase in productivity, you also had, you know, like huge supply disruption globally. So you had all these people sat there with a load of money in their pocket, and yes, you had too much money chasing too few goods. So it was a really obvious one for everyone to go, right, we're going to have like huge consumer price inflation, asset price inflation as well, because it won't all just go there. But you're going to have both huge asset price inflation, huge consumer price inflation, and you'd have to be a central bank or government to not really understand that.
So then how does crypto fit into all of this? Because obviously most of the cryptocurrencies we talk about these days kind of stemmed from that period post 2008. So
yeah,
give me this kind of 101. I know nothing about it. Tell me in really basic terms what crypto is, what the central principles, and then I think it, as you said earlier, that difference between Bitcoin and the others. You know, for example, I was speaking to Antti Scaramucci not that long ago, and he's a big Solana guy because it's the underlying technology he sees the value in. And I think that is an interesting difference point that most people don't see. You see Bitcoin, and most people see that as crypto, but that's not quite true, is it?
No, exactly. So I guess if you look at Bitcoin, there's a couple things. I mean, look, first of all, like quite simplistically, it's like it's a decentralized network, right, for transferring value. It's like a ledger system, right? So if I send money to you, right, we have a centralized system, a bank, right, that creates a ledger, like a debit entry for me, like credit entry for you, that balances all, and they manage that centrally, right? But we trust in that bank to manage that process for us, for me to send money to you. So Bitcoin is this decentralized system whereby I can send money to you without a central counterparty. How do we do that? Well, we have this decentralized network through this, what we call proof of work, that essentially, for real simplicity, to validate the transaction has to solve a really complex like math equation, which is just an iterative thing, which takes a lot of power because it needs so many computations. But once you're the one to solve it, then you get to validate the block to confirm the transaction and settle the transaction, right? So it was a way of removing a central counterparty, so that I could trustlessly send value from myself to you, right? That's and it maintains a ledger, and like a blockchain is it's the chain of all these ledger entries and movements, right? And so say the proof of work mechanism is I need to do this, you know, run these different like these like keep trying to solve this equation and run these iterations, which is going to take a lot of energy and power to do that, right? But that work, there's value in that, because once I do it and I win it and I get to validate the block, then I then get rewarded with Bitcoin, right, for that. So there's a part of it just as a pure technology to transfer value in a trustless, decentralized way without relying on a central counterparty. Then there's the other thing of looking at what the issues with money are and what's gone wrong in a fiat, what we call a fiat money system, where essentially money that's not backed by anything. Now, for years, gold like backed money, right? So a pound note or a dollar essentially represented like gold that was held at a central bank vault. And when you had trading between countries, the balance of the trade got settled literally by moving the gold, right? But the value of your output and the value of your currency and your GDP was matched by an underlying gold, right? Problem with that is quite restrictive, right? In terms of when you're trying to like expand, like it's slower. So you had the whole so what kind of pinned that was you had this Bretton Woods system. They moved away from that in the 70s and said, right, we're now not going to tie the dollar to gold. We're just going to print it freely. And that started, then all of a sudden from that point, money became worthless because you can just print as much of it as you like. And there's no, it's infinite in supply. So the other thing, the reason gold always maintained its value is because it's not finite in supply, but it's relatively sort of finite in supply because it's, there's only so much, I guess there's only so much that you can mine. But again, core Bitcoin people will say that, well, actually when price goes up, mining supply increases quite quickly. But so Bitcoin was designed to be like the kind of perfect hard money in that there's only 21 million Bitcoin that can ever be mined. So we know that there's that can never change. There's no one that can just say, right, we'll now increase it, because as soon as they do that, the value of Bitcoin will collapse. So there's going to be a limited amount of Bitcoin. So essentially it's created this digital gold. So how do we create a scarce asset that has value? So you've created this, it can only be 21 million. It's to mine it, you have to go through this proof. You have to use electricity and energy to mine it, to do this iterative process of solving the equation, or to have the right to mine it. So it's kind of doing all those things that gold had, and limiting its supply. So it's really a form of hard money, and kind of keeps an anchor within that system. That's probably still quite complicated to get a head around, but yeah, I mean, I think really simply, I think of Bitcoin as a form of money. It's a form of electronic money. They've solved the problem with how can we transfer that value around the world without a central counterparty, and we've done that through this process of proof of work, and through a network of computers that race to be the one to actually validate the blocks.
But then you've got the other side of crypto, and some of those currencies that are actually kind of underpinned or underpinning technologies, like Ethereum, like Solana. My view on those is if you were to buy Ethereum or so, you're almost becoming an investor in the technology itself, which I think is where a lot of bullish investors in those types of coins tend to sit. But what's then that difference? So if you've got the kind of the digital gold of Bitcoin, what does Ethereum and Solana do that Bitcoin doesn't, and vice versa?
Yeah, so then when you think about, so Bitcoin was this really kind of beautifully simplistic product, and that it's a monetary network that can transfer value around the world, just with an internet connection, decentralized, limited in supply, so it made it really sound money. And that was Bitcoin, right? And then Ethereum came along with the idea of, wouldn't it be good to make like programmable money, i.e. we can build contracts on top of that. So Ethereum came along with the purpose of basically to create a layer whereby we can create these smart contracts that we can agree on how we're going to interact with one another. Bitcoin wasn't set up for that. Now there's ways that we can still do that now on Bitcoin, but that was what Ethereum was for. So Ethereum came out saying we're going to be like a decentralized world computer, essentially, right? So similar principle in that transactions happen on our network. It's decentralized, it's kind of validated. Originally it can start as proof of work and now proof of stake. But again, like a decentralized network that we can actually build things on, we can build applications on. So that was kind of where Ethereum was different. So Bitcoin was kind of originally just there to be this digital money with these digital gold characteristics. Ethereum started out as we're going to be like this decentralized computer where transactions, you know, can take place via these smart contracts that agree on, if I do A, then you must do B, and we can automate it. So I think everyone kind of, and actually what's really changed for me over the last couple of years is particularly those that are against crypto, they've all started to understand the efficiencies of blockchain technology, right? The ability to, you know, like instantly settle transactions, and just the speed of it. And it's just a better technology. I still think what people struggle to get their head around is, particularly like the banks like JP Morgan go, well, we're going to have our own blockchain, but we're going to validate the transactions on it, right? We're going to be a centralized entity that just uses more efficient technology of settling things. The likes of Ethereum that I've tried to go, well, we're like decentralized. Now, again, how do you incentivize people then to take part in validating transactions on that chain? Well, then you have to pay them in ETH, or you've got Solana does a very similar thing. Like you have to pay them in Solana, or so you have all these what we call layer ones. Now, the way I just try and think about them is, I think of all these different networks, Ethereum, Solana, like I don't know, Algorand, all these different sort of layer ones. I think of them like in individual economies is probably how I think about it. So if you think of like the UK, and you have all these people in the UK that are producing things, building things, selling things, and to transact in the UK you need pound sterling, and the value of that pound is really related to the value of the economic output of the economy, and the demand globally to buy UK goods, and how much, you know, the network effect of how many people are transacting in sterling, right? In theory, that's so the value of sterling, the more productive we are, more exporting, the value of sterling should go up relative to other currencies. I think of these layer ones in a similar way, in that, so the Ethereum network, people are building on it, they're building like applications and what have you, and transacting on it. Obviously, we've seen like stable coins, which kind of, I think people kind of get their idea. A lot of stable coins transact. I think over 50% of stable coins transact on the Ethereum network, right? So to send the blockchain that they use is the Ethereum blockchain, and the price of transacting that is you pay Ethereum. Like there's what we call gas fees and stuff, and you pay in Ethereum, right? So the more that economy, the Ethereum economy, is being used, the more value will accrue to the Ethereum token. But yeah, so if I think of like all of the other layer ones, like economies, and their token is the currency for transacting and being a part of that economy, if you like.
So if there was a, you know, let's call it the British digital pound, for example, and as a stable coin, so one digital pound was worth one pound backed by the Bank of England. The way that works is I take my regular pound. How do I then put that into the digital pound? How do the transaction works? Because I've got that digital pound that I can then transact with someone else with digital pound. But then how do I convert that back to my regular pound? Because I think this is what people want to get their head around a bit more, which is, how do I come out of this fiat universe, this where I have real money, it's in my pay packet every month, to then this digital universe that I can't quite get my head around because I can't see, or I can't go to an ATM and withdraw it in that same way. How does that process work? And do you think that's going to become a bit more second nature because the technology we're seeing so many, I mean, governments are starting to look at it with the regulation moving, so it's going to become more ubiquitous and more more commonplace. So how does the everyday person on the street, how would they go through that process?
Yeah, so so like with stable coins, so again, like if you think of the blockchain technology, you know, to be able to be able to move on that technology, right, you need to be a digital currency, right? So the idea with stable coins was, right, okay, right, like so the fiat economy, like that we all like live our day-to-day lives in outside of crypto, you know, relies on like different payment systems like Swift, right? A centralized payment system that allows us to send money around the world, which is essentially controlled by central banks and the commercial banks. So, and it's also what we call like the Swift messaging of when I send like, you know, a transaction. But again, it all comes down to code and messaging. So the idea on to be on these blockchain rails, right, you need to be a digital currency. So essentially, if you take, say, like Tether, like USDT, what you're doing is you're going, right, okay, I want to exchange $1 for a USDT. The company issuing that Tether, you're literally sending them dollars through normal, like you'd make any payment to anyone. They're taking that, and they're actually then like they're buying treasury bills with it essentially, right? And then they're issuing you a USDT token, right? That will then sit in your wallet, and then all of a sudden that will give you the functionality to then be able to send it across, you know, through blockchain rails. So it's like, yeah, you're just converting like one for one from a fiat currency into this digital currency. But the issuers of those are typically then backing it with, say, by buying like short dated like government bonds, that should be safe, right? So that's then the idea is then your transactions send around the world, and then when you want your money back, essentially what they would then do is like sell the government bond that underlies it, so which should, you know, keep value obviously with the actual underlying currency. They're obviously making interest on it. That's how they make their money. And yeah, and then they'll send you your pounds or dollars back.
So
yeah.
So the likes of Tether are acting like a central bank.
Yes, they are. Yeah. But without controlling the original supply of it.
Because that supply is driven by the user demand.
Yeah, because you still, like, they can't just create Tether out of thin air, right? They need someone to, right, here's $1, right, now I can give you a Tether. now there's a lot of what we call a Tether FUD out there that say no, they are just creating out of thin air, right? But like they're not. And this is why, again, why these digital currencies need you know, to be regulated, so that we're comfortable that, you know, I'm not saying I'm not just giving out, you know, all this, you know, Brickell coin, which is a stable, you know, sterling coin, and trying to, you know, put it out into so everyone's using it. But actually, if people try to redeem it for actual sterling, I go, I haven't got the sterling. Like, so the idea is that's why you want these things to be regulated. But yeah, they should be backed one for one, and then consequently, as a result of that, it still ties back to, well, where does the original currency, who controls the supply of that, which is still the central banks.
So obviously a lot of us will hold cash, whether that be part of our investment portfolio, savings, pensions. I remember when we worked together that one of the stats that I pulled was if you had something like 0.5% of your pension in Bitcoin, whatever that year was, it would have outperformed the other 99.5% of your pension. Obviously, this year is not the one to draw from.
Not the one, yeah.
But particularly with things like crypto ETFs and ETPs that have come onto the market and been regulated by the SEC in the last 18 months or so, do you believe personally, and do you think for retail investors that people should have some form of exposure to crypto in their portfolio of various levels depending on their risk tolerance?
Obviously not financial advice. Yeah, I do. To be honest, I think people should hold Bitcoin. definitely, rather than necessarily other tokens. See, my problem with Bitcoin is my problem with other stuff. There's only one Bitcoin, right? And that one, right? People go to me, oh, but someone else could like recreate the same thing. You could, in the same way that someone could, someone could recreate the internet, and we could all start using a different like. It's like, well, that one, right? Bit like, Elon Musk could have created another Twitter if he wanted to, but it was like Twitter was there to get the network effect was just going to be too costly and take too long. So he paid 42 billion and bought Twitter. So the problem with the other layer ones is, like I described them as all these different economies. So there's digital gold, which is Bitcoin, and you've got all these other cryptocurrencies that are networks and economies. It's hard for me to know which one's going to win out. Like, you feel like Ethereum is, because it's got the first mover advantage. You're seeing financial institutions build on it. So you kind of think that that's probably going to win out, like, long term. And there'll be people that it's quite tribal, as you know, in this space. That'll be like, look, I don't know, and I'm sure there's going to be like Solana. I use Solana a lot. And they've all got their advantages, but again, they're like tech plays, right? And I don't know, are you buying Facebook or are you buying Friends Reunited? Like, you don't know, like, but some of them are going to be probably the most valuable assets in the world at some point, and some of them will go to zero. And I think that's a harder play unless you're really like in the weeds of it. I think Bitcoin's like here to stay. It's being, added to, sovereign wealth fund reserves, to strategic reserve asset in the US. So I think it should form definitely a part of an investor's portfolio, and depending on your risk tolerance. The other thing I think with Bitcoin is, like, look, and obviously the gains are going to slow as like we mature, but for 10 out of the last 14 years, it's outperformed every single asset class like in the world, like for 10 or 14 years. The drawdowns obviously are big, the volatility is big with it, and you kind of have to think about that in terms of how much you take. But I got into crypto many years ago, and Bitcoin, I saw it as the biggest investment opportunity I'd ever seen, and I still feel that way. I still think we're very early. When you think of, I mean, what's Bitcoin now in terms of market cap? Like $1.5 trillion market cap. It's tiny. It's tiny. In fact, the whole industry is now what, 2.5 trillion, maybe 2 trillion with the recent sell-offs. There's like $800 trillion worth of capital out there in the world. We're such a small part of it. So in terms of having a part of your growth like portfolio, it would seem silly to me to not have a part of that in Bitcoin. So yeah, I to friends and family and everyone, I would always say you want to be holding some of that in your portfolio.
I was watching The Big Short last night because it's the one of 3 films I keep on rotation, obviously.
Yeah.
And the one thing I always come back to is the fact that these people who knew the risk, obviously it's dramatized, obviously it's Hollywood, but these people who knew the risks continue to do so anyway. And I think that particularly after 2008, was it one Icelandic banker went to prison after crashing the global economy, and going, I totally hear what you're saying, like, we need to treat people like grown-ups, but financial institutions have just continued to just be water off a duck's back when it comes to stuff, and they just self-reward, and it's an attitude that I think regulators look at and go, we at least need to be seen to be doing something in order to protect the people who put us in power.
Yeah, but I think that's absolutely right to regulate from the high level down, in terms of like, look, when you know the potential impact of what your actions are going to have on a broader market. I think there's a difference between that and then saying, like, I don't feel there should be a regulation that, like, to say to someone, like, do you know if you buy crypto it can go to zero? Like, people should fucking know that. And if you can't, like, it was a bit like, reminded me of when people said, oh, like, Trump compared some of the stuff they were doing during COVID to like it's almost like a bleach, right? Like it kind of cleans it out. Like that I heard it when he said that, and he was like, yeah, like there's seeing it almost acts like a bleach to clean, which obviously someone said to him. This is kind of trying to put it in layman's terms. it's like a bleach that almost clears it out. And it was like, oh my God, people gotta start drinking bleach. Like, how irresponsible is this? I'm like, Joe, I think the people that are going to listen to that and go and drink bleach should probably go and drink the bleach, because it's probably on net a benefit to society. If you're going, oh, you said I should drink the bleach, it's going to cure my COVID. It's like, he didn't say that. And I hope you do know that drinking bleach is really fucking dangerous. And if you don't, I don't. But there's the fact that there's like the warning labels on that do not drink bleach. It's like, but are we taking away people's sense of responsibility to not do stupid shit? But it's just a lot of it's just an arse covering exercise, right? Like, or
do we like to think the people in charge know what they're talking about?
Yeah, a lot of it. God, we are really going to struggle. We're going to keep this half an hour, but a lot of it is, which actually really annoys me. A lot of it is just arse covering in a culture that is, everyone gets sued. But I my first ever job, really fucking boring. I was an economist for government, and my first, you work for essentially for the government economic service, and you get seconded out. And my first secondment was at the Food Standards Agency, and it's like the worst job I've ever had. But and you're advising on like regulations, obviously, with food and stuff. But it's made me like so annoyed from working there. Just firstly, like it make you hate government more than you could possibly hate them in a way. But like on and it's funny because I've got a niece who's got a really bad nut allergy, right? And the annoying thing for me is that I think food labeling is so irresponsible. And the reason I think that, because everything's got may contain nuts in it, right? And the risk assessment on may contain nuts is like, there is no fucking risk. Like, and it's funny, I argue this from a point of view with a niece that is at risk if she has something that is contaminated with nuts, could potentially kill her. I think labeling is over the top, and people are like, well, aren't you? I was like, no, because it's not protecting though. The problem is I want a real risk assessment done, and it's limiting her choice and everything because it's saying it may contain nuts. And now my brother and his wife are in a position of kind of trying to call it like, I think that'll be okay, and they're probably going to end up at some point, hopefully not, but giving her the thing that actually is a risk, because it's now, well, you're putting it on everything, so therefore I don't really listen to the warning. But it's because we've got a factory here that makes this chocolate bar, we've got a factory there that makes the Snickers bars, it's got nuts in it. There's no conceivable way that there can be cross-contamination, but there's a 0.001 let's just say may contain nuts on this thing. We know is fine. There's no risk of contamination really, but who knows? Better than we get sued, right? And it's like, well, it is for you, but it's not for that person who wants some choice, and you're not doing them any favor. And now I say you're now creating a weird thing that people start to know that, and know that most things don't contain nuts, so therefore they're going to eat the thing that will contain nuts. That if it was a reliable thing, oh shit, when it says that, it means it is that there's a higher chance it may. Right.
So I totally agree with what your brother and his wife are going to be going through, because we were at dinner once with a celiac, so somebody who can't have gluten. It will put her in bed for a week or two. Completely will wipe her out completely. And we're with another person. So she said, can I just double check the gluten-free pizza? It's actually gluten-free, and she didn't say because I have celiac disease. She just said, I just need to be really careful. But yeah, no problem. So she orders a gluten-free pizza. The other person at our table orders a gluten-free pizza, but then orders the dough balls. And what you've then ended up with is a situation where it goes, oh, well, these people just don't want to eat gluten. So actually, I don't need to be that careful. Because on the table, not only have they ordered two gluten-free pizzas, but they've also ordered the dough balls, which have obviously got gluten in them. And I think what you end up is a situation where people then become more and more relaxed about the things that actually could really harm some person. And actually, you just need really clear like guardrails in place.
Yeah.
And we're in a situation where, because everyone thinks that everybody's too over the top, the guardrails just get looser and looser until something genuinely bad happens. It's like that girl had was it a Pret-a-Manger baguette or something a few years ago and ended up dying on a flight, and they brought in a law for that because they hadn't labeled something that had this, because they put a capsule may contain nuts or may contain seeds or something. And then all of a sudden you go, oh, like be more precise.
Yeah, yeah. But my it's funny because my mum's got a really bad egg allergy. Like again, she ate an egg killer type thing, and the nightmare for her was, do you remember years ago the salmonella, like get like eggs, and so obviously going into restaurants there was lots of people asking, does this contain egg, does it contain egg? And restaurants are obviously getting to the point where they're like, oh, like you're not going to get salmonella for fuck's sake, so they would just go, no, it doesn't. But like my mum used to have to say, like my mum used to have to really make clear, I don't care about salmonella, my family can eat the egg, I really don't care about that, I'm really allergic to egg. It's not a salmonella thing, so please, you must be up straight up front with me. Does this have egg in it? Give it to them. I don't care. Salmonella, keep them salmonella. But it's I'm allergic to egg. Okay, that's it. But like she, I mean, like yeah, and it's funny. She for a while she was getting really ill. Like it kept flaring up. And didn't realize Chewits have got, Chewits have got egg white in them. Like so, there's like lots of shit that's got egg in it. A lot. She can't take a lot of medication, a lot of medicines, because they're the however they're kind of, they start off being producing some sort of egg white, and then like that's how they do. So there's a lot of there's like so many things that egg is in, but yeah, it's like that was a nightmare for her at that time, because it was like everyone's crying wolf. So yeah, there's a difference when if you're like, oh, you're another one who can't eat gluten or whatever, like fucking hell, like just have some fucking normal pasta, you idiot.